The wheel strategy has produced very consistent income for me. Even on stocks that don't pay dividends, the wheel creates very reliable income. It's a fairly low risk strategy.
It is one of the most popular options trading strategies out there. We're talking about the wheel. My guest has done more than 8,000 wheel trades. Welcome, Paul Gundersen.
Well, hello, John, and thank you for having me to your program today. I'm happy to share my life with the wheel because I've done it for about the past 5 years quite consistently.
So give us the 40-second version of what the wheel is and how it has worked for you.
Well, at a high level, the wheel strategy has produced very consistent income for me, which is important to many people that they need that consistent income. I'd say in general, 12 to 15% from the wheel per year, and then an additional 3% in dividend income generally. So I'm getting between 15 and 18%. My version of the wheel is simple. I follow the process, which is essentially 3 steps: research. There is to determine what stocks I'd like to own. And then there's a process called the cash secured put at the top of the wheel, a covered call at the bottom of the wheel. You'll learn about this as we go. And then the only other thing I'd say is I like what I call sci-fi trades. Set it and forget. And my version of sci-fi is that I will spend about 15 minutes in the morning, after the market opens, and then about 15 minutes in the afternoon, adjusting my trades, making new trades. And that's it for me. I'm not in a position where I can easily be on, like in a trading group, on a call all day long. And I prefer to be out biking and doing other types of things.
And we will dig into it, but first, a little bit about yourself. And being a Norwegian, I know your family came from Norway, which I am happy about. And of course, here we would pronounce your name Paul Gundersen and not Paul Gundersen.
Very well, Jan. Very well. Okay. My grandfather was a Norwegian ship captain. And so I always, when I'm by the ocean and I think about it's a cold, damp day, what life must have been like in the 1920s and 30s and 40s on the ocean. So that's my roots from a heritage background. Now, as far as me, I've spent most of my career in the software business, in sales, delivery, consulting, big and small firms like Accenture, Microsoft, some mid-cap companies and entrepreneurial firms. A guy named Dale Perryman, who runs a group called Trade Diff, introduced me to covered calls in 2015. And then I think so I've been doing this for a while, but principally the last 5 years, quite a lot. And then I transitioned into financial coaching upon retirement. I thought it would be a good way to give back to people in terms of a skill set that I like and that I'm good at.
So let's dig into this strategy. What is the wheel?
Well, let me take you to a different place for a moment in terms of describing the wheel. I liken it to a real estate analogy. So it is a technical option strategy, but it's a relatable real estate analogy. The idea is that if I have a property and I go buy this property and I rent it out, I put in place a lease with a tenant for a term. And in exchange for that, the tenant pays me money on a monthly basis, right? Now, that is sort of like the wheel. We have this idea that I own a stock, and that would be the property. And now, on that property, I want to make income. So, I do my research before I buy the property, whatever that stock is, and then I can sell a put at the beginning of the process, which is like the landlord who collects rent before the potential tenants move in. There's a notion of, and what that means is I found a stock I'd like to own, and essentially, if it goes below a certain price, then that stock ends up in my account, and I sell this put, which means that I collect some money for it at the beginning of the road. So now I own this stock. The second part of the process is that I can sell a contract against that stock, which is the lease, and I can continue to collect premiums, which is like my monthly rent when I own this property. So and then the idea of selling this covered call, as they call it, is that if the stock goes above a certain price, then I part with the stock. And I say, I'd be willing to sell it if it goes up to this. And then after that, I'd be willing to part with it. But all the while, I've collected some rent because the person who bought my contract gave me money at the beginning of the road, and I keep it forever. So why people love it is that even on stocks that don't pay dividends, the wheel creates very reliable income. It's not about betting, it's about a disciplined approach to cash flow. And I think it's DIY friendly. So if you are a do it yourselfer, you don't need Wall Street to do this. You can learn it just like you learn to drive a car.
And we have a slide that gives an overview of this. So maybe we should take a look at that one.
Yes, it's a 3-step process that follows a little bit of what I spoke about just now. Well, the stock selection, where you create a list of stocks that you'd like to own. You have to do your homework on these stocks, and I'll get into some of the metrics that I use later in making my purchases. And if you don't do that, full stop. Don't move forward. Do your homework and pick stocks that you have a belief in that will do well in the long run, that you'd be willing to own. What they call the top of the wheel, if you think of a circle and we cut it in half and we're looking at the top side of it, the idea is I don't own that stock yet, so I sell this security. I sell an option that is called a cash secured put. And it has, maybe I buy it 2 weeks out, and at the end of 2 weeks, we sort of settle up. Well, what happened in the market? Did the stock go down? Below my strike price, as we call it? Yes. Okay. If it's below, then I end up getting the stock in my account. And if not, then I go to the top of the wheel again and I start over. I sell another cash secured put. And then what they call the bottom of the wheel is that in step 2, if you've been assigned the stock and it's given to you, then you start selling covered calls against that stock. And then it has these calls are just kind of the reverse of the puts, but they have an expiration date as well. So now you say, hey, I bought it at 100. If it went to 105, I'd be willing to part with it. And if it stays below 100, you roll to the next contract and you sell another covered call. So it's a 3-step process. And like anything, you learn to drive a car. There's a vernacular to it that everyone needs to understand and learn before putting money into the market.
So let's start with the first step, your mechanics for entering into selling the first cash secured put. How do you choose which stock you will do this on?
Everyone has a list of stocks that they may know about. So I ask 4 questions. I say, first, do I generally understand this business? Like I'm into software companies and big S&P companies where I kind of understand what they do. I don't really get into biotechs much because I don't understand that business. So that's my first criteria. Do I understand what business NVIDIA is in? Or Enphase, who is in solar, or First Solar? Do I understand that business enough to say, get into it? 2, are the revenue per share and EPS increasing year over year? So I use a product called fastgraphs.com to do that analysis. They do all of the analysis for me, and in a couple of seconds, I can say, am I seeing good revenue increases, because that's the hardest part of any business to generate revenue, and profitability, EPS, are they increasing over time? Thirdly, can I write a short paragraph that says, why own this stock? So I keep a OneNote, and in every single OneNote, if I'm in the wheel, I have done these 3 steps. And I have to be able to write a little paragraph with just a couple of lines, a couple of bullets that say, why should I own this? And that's what Warren Buffett would tell you to do. And then lastly, 4th, is the juice worth the squeeze? The stock needs enough volume of trading and volatility in terms of price movement to be a valid candidate, because if there's not enough volume, you can't get in and out easily. If there's not enough volatility, the premiums are very low. And so the combination of those 2 things, I have filters I built in Thinkorswim that just give me a list of stocks that are over a certain amount in volume, and then volatility is over about 30 or 35. Now, that generally leads me to S&P 500 and NASDAQ 100 stocks, which is where I prefer to stay.
And now you have chosen your stock. Then I wonder, how many days to expiration do you choose and why?
Well, that's a good question. And I've given that question about DTE, days to expiration, a tremendous amount of thought. The principle of what drives my trading and choice of DTE is this. The better money is always closer in time and 2 to 3 strikes off the line of scrimmage, meaning the at the money line, as we call it. Why do I say that? Because better money, meaning if I took the premium that I'm going to receive for that option trade and I divide it by the position size, and then I annualize it by saying, how long am I going to own this thing? For 2 weeks? Well, then I get 26 more tries if I've held this thing for 2 weeks before the option expires, right? So I'm going to get a higher rate of return if I stay closer in time. And if you push something out a year or a month, then you get 12. 1 month, you get 12 tries. A year, you only get one. So it causes the annualized returns to come down. So the principle I follow is to be as close in time as possible. But let me give these 2 pieces of guidance. If you're a beginner and you want to do the wheel, then I would suggest you start with monthly options. And just once a month, if you're a set it and forget it kind of person, you're very busy, once a month, do your trade. Okay, and I'll get into more mechanics as we go down. And then if you're an advanced trader with a process that you really have a good process for monitoring your trades and keeping up with them, then weekly is what I would recommend. But the DTE, the closer in time, you will always have higher annualized returns if you stay closer in, is the principle.
And what delta are you aiming for?
Well, let me share that in 2 ways once again. So for beginners, if you're getting into this for the first time, stick with a 20 delta strategy where you're maybe putting an option 1 month out and then at 20 delta. And then the next month, the stock price has moved around, go ahead and roll that to the next 20 delta 1 month out thereafter. If you're an advanced trader, I trade 45 delta, 30 delta all the time because I'm rolling is a big part of my strategy. Now, what is a roll? Let's go back to our real estate analogy. The idea of a roll is I have a tenant in my property and I don't like them. I want to buy them out. So I pay them to get out. And then I sell another lease and I get another tenant and I net the difference, right? So so I am rolling all the time. And so I used to follow 20 delta, but sometimes the money at that level is not as good as it is closer down to the line of scrimmage, the at the money line. But anyway, I think that I trade all over the place. I tend to not go, if there's a trade that goes below the my purchase price or below the at the money line, underwater, if you will. Now I'm inverted. I tend to roll into an out of the money type of position. Has been my way because this is costly to accumulate a lot of intrinsic value. You don't want to have that in doing the wheel.
Are there other considerations you take, like when is the earnings, VIX level, or other criteria?
Avoiding earnings releases is a good idea. I can tell you that I have a visceral reaction when I get in. I sell a cash secured put right around earnings. The earnings are better than expected, but the future is less than Wall Street wants. And so then the stock plummets 20%. And because I sold a cash secured put, I end up owning it 20% below my strike price. So earnings releases are good to avoid. VIX, I know many people pay close attention to it. I just don't seem to follow it that much for these types of trades. But I would say that one of the criteria that I have is around holding period. And the question I pose to most people is, are you willing to hold this stock for the long run and then continue to roll and roll and roll and make money on those rolls until the stock price recovers? Your answer to this question is, I think, largely determined by the research you did, your early research, and how long you think it will take for that company to achieve its strategic vision. Now, let me just touch on that idea for just a moment. The idea, take a Walmart 25, 30, 40 years ago, take an NVIDIA today, take a Microsoft in the 1990s. It was going to take them 25 to 30 years. Let's take Microsoft to achieve their strategic vision of putting a PC on every desktop and in every home, all running Microsoft software, right? So if I have a stock that I go, I like this, I did my homework on it, I can say it's going to, I can write my one simple paragraph. Well, I'm comfortable holding stocks when they're well below the purchase price. And I just continue to roll my options and I make money on it. And the last thing I'll say, because this is important, is that when you buy a property and you're going to rent it to someone, people don't naturally go out to Zillow.com every day and check the price of the property. They keep wanting, as long as they get the income, they're comfortable. And so that's a mindset that is necessary to trade the wheel, so that if the price goes down, you don't panic and get out and lose on the underlying.
Tell me a little bit about your way of managing. We have talked a lot about rolling already. Do you prefer to just roll on the cash secured before taking an assignment, or is this something you do after you have been assigned the shares and sell the calls?
Yeah, good question. Well, let's start at the top of the wheel with the cash secured put. I will pick a price that I'd say I'd be willing to own that stock at this price or below. But imagine you have a stock that's trending and it keeps going up and up and up. Like, so I'll sell that cash secured put. And if it's out of the money at the end of the cycle, then I keep the money. I don't get the stock. And then I'll say, has the price moved up in such a way that I'm still comfortable getting in? So I'd bump up my strike price. I might do that. But at some level, I say, no, I'm not going to do that. But I have had stocks where I've done cash secured puts for weekly for 6-8 weeks, and I've brought in money every single week on the CSP. That has been great. I would say stay out of the money. If you end up in a situation where you're in the money with the option, then for you to buy your way back to an out of the money situation, you're paying for the difference in the stock price versus the strike price, and that can get to be expensive. So you want to minimize the situation where you get into the money. I pay close attention to days, what I call distance to strike, and then days to expiration. So I'm always looking at, if this is my strike price and the price is up here, 5-10% above my strike. Well, let me see if I can roll down and in order to pick up a couple of dollars. That's why I have so many trades over 5 years, because as the price movement happens, I'm always saying, I can probably roll down and in and make a few bucks. So I'd say that. And then for beginners, stick to that 20 delta idea on a rolling basis. And for advanced traders who roll from one contract to another, my experience is that this has increased my profitability by probably as much as 50%. You'll have different results, but I roll often, and the way that I keep my option trading and my wheel trading to a sci-fi situation, set it and forget it, is that I'm rolling quite often, but making very incremental changes. But those add up. You get $30, $50, $100 on a trade. You'd be amazed in a month at how quickly it adds up.
So Paul, let's look at some visuals that illustrate the two trades: the cash secured put and the covered call. The cash secured put first, maybe.
Okay, well, very well. So on this chart, I want you to imagine I don't currently own the stock yet. I went through my research. I don't own it, but I'd be willing to own it in this example if the price were $95 a share or less by expiration. So now what happens is the current price is at 100, and you've got to make this decision in option trading. What if the price went from $100 to 70 or 50? If you sold that contract, that cash secured put contract that's in force for a period of time, if that stock price goes below 95, you're going to own it at whatever that price is. So what it means is you have an initial unrealized loss on your stock. So be aware of that going in, and this is the idea of I'm at now, where the little green triangle is at the bottom. And in 2 weeks or a month, this contract is going to expire. So this is that lease idea where we talked about before, where you're collecting money, you get $75 and you keep it forever, but you have to be willing to deal with this challenge of, well, the stock price could plummet on me, like if I did it around earnings, right? So I like for people to understand this visual when they're getting started about the inherent risk when you say, hey, I'll sell this contract. Well, what if it went to zero? Hasn't happened to me, but I've had 20% drops for sure. Yeah.
And we have the covered call.
Right. So this is the reverse idea. So now I own the stock. We call this, I'm in the bottom side of the wheel. And now your mindset changes. You say, hey, I got it at 100. I'd be willing to part with it if it went to 105 by a certain date. And in exchange for that contract, the buyer of my contract gives me $100, which I pocket and keep forever. And now you have the other scenario. This is the one I hear most often. Take NVIDIA, right? It's going way up, or Palantir, it's going way up. Well, what if that price, you're saying I'd be willing to part with it at 105, but what if it went to 125 or 150 on a big, like Oracle just jumped crazily, right? What if that kind of thing happens? Well, your gain is capped at 105. So if it goes to 125 or 150, you make between your purchase price of 95 and 105. So you make 1 point or 10 points plus the $100 you got. And then because you're capped at 105, the buyer of the contract now is going to reap that benefit of all of that intrinsic value that is above the strike price. So, it's the reverse of, well, that price could really take off, and they do sometimes. I've had it happen, but you can't lament it. You have to say, I'm trading a strategy, and I did well by my set of rules. If you're following your rules, that's a good thing. And if you want to make to the top of that peak, then buy and hold it as a growth stock, or do something else. Other choices.
You are basically paid a premium regularly to take on an obligation.
That's exactly right. We have an obligation when we sell that contract until the expiration date.
Well, one thing is, if the price jumps far up, you have to part with the shares. But what if the price drops dramatically? You already own the shares and it drops dramatically. How do you set your covered calls then?
Well, this just happened to me, so I can talk to it. Okay, I got into Okta and Workday. And I bought them on a slightly different strategy than this before expiration, right before earnings. So earnings day happened. Price plummets, it went down 20%. So this is exactly your scenario. I got in and I have an unrealized loss of 20% right out of the gate. Now, what I will do is I will continue to sell covered calls. I'm in the bottom of the wheel. I will roll down beneath my purchase price and I will sell covered calls against that. Now, that's more of an advanced process because to the person who rolls below their purchase price, thou must have a solid tracking mechanism so that you know what's happening and you're able to move these contracts around quickly because there's a volatility component to stocks at all times. And if it moves against you, then you don't want to be assigning below your purchase price. At least that's one of my rules, is to say that. But I'm comfortable with that. And rolling beneath my purchase price has increased my options premium, like I said, by about 50% compared to if I just keep my strike price above the purchase price.
But isn't there a risk that your shares are taken away from you far below your purchase price when you do that? I know many other traders just wait it out, and then when the price comes up again, they will sell the covered call.
Right. So there are some who wait it out until the price recovers. And I did that for a very long time. And then one day I thought, well, let me try this rolling beneath my purchase price because there's money down there that I'm missing, right? But in that scenario, you have to do monitor, say twice a day minimum, twice a day. Keep your eye on it, and then if you get in the money, you have to roll your way out of the money at all times. So I may take a debit on a roll in order to get out of the money, but I'm always trying to be sure that my strike price is above my the last price. So there are three variables. There's my purchase price, there's my strike price, and there's whatever the current price of the stock is doing, right? So I'm always trying to stay where if this is the last price, my strike price is here. If this thing moves up, I'm going to roll above it, right? And if my purchase price is way up here at the top, I'm going to keep rolling. And I have examples of this where I've held stocks for sometimes 2 years, where they went down in the trough and they stayed, on a bottom for a while, and then they finally recovered. And at the end of that trade, I end up making 20% on my money, even though the underlying did nothing. And that's because I continue to roll, I continue to collect dividends all the while.
But doing this, if the price keeps falling and keeps falling, you are taking on debit when you roll down, and in that way also increasing your risk, aren't you? What time?
Well, I suppose.
When do you give up?
Yeah, I haven't had that many where I've given up. I have had a few where they may have, Bed Bath & Beyond went out of business was a good example of one where I gave up because I just saw that this thing is going nowhere. Another one that I gave up on was Kohl's. I had Kohl's. Now, some people would say, gee, why would you trade a company like that in retail? But surprisingly, Kohl's turned out to be one of my top 5. In one of my accounts, it turned to be one of the top 5 trades that I did. So there are times where I'll give up, but I have this conviction based upon the research I do that says, a great one right now, Enphase has dropped considerably, probably 55, 60% since the Trump tariffs came into effect. And so on that one, I believe solar and renewable energy is here to stay. This thing is going to come back at some point, but probably not during the Trump administration, right? So that's one where I continue to roll all the time. And in I think this year, it's one of my top 5 income producers, despite the fact that the price of the house went down, the price of the property went down by quite a lot. So, at any point in time, if I did one of these graphs where you show the bars and it starts at the top with the most money to the least to the bottom, I'm probably 50-50 in terms of the number that are above the S&P performance and the number that are below. So it's a market basket.
I always ask my guests, what is the worst that can happen with this strategy?
Well, I think the worst is that at the top of the wheel, where we're selling the cash secured put, we don't own the stock yet, is you can be assigned a stock that is well below your strike price. So if your strike price is 100, you could be assigned at 80 or at 70 or $20 a share. So that has happened to me, but you still end up owning the stock at the end of the road. And then, that they do recover, many of them, over time. At the bottom of the wheel, the worst that can happen is that the strike price once again can plummet well below your purchase price, or the stock price can increase well above your strike. So I had this happen with Accenture a couple of years ago, where I had a strike and the stock, it was Meta. I had Meta, and one day the stock gapped up and it was like 20% higher, which meant that if I were to roll up, it was going to cost me $20,000 to roll in that position. And I just didn't have the money in my account. So at some point, Meta got called away, and it was 70% above my strike price. So I was done. That's the worst that can happen. I still made money on the position. I still made income. It was probably 20% to the good when I netted it all out. But that kind of thing can happen. Yeah. And in all cases, you must consider then, what is my investment objective? Is it growth? Is it income? Can I continue to roll and make money? Am I continuing to generate income on the property, if you will? So thinking of it once again, like owning a property. When you buy a home, you don't go to Zillow every day and check the price. So, and I guess the only other thing to say is there is no theta decay on the underlying because it's 100. So that's unlike if you were to sell a long position like a poor man's covered call, where you've got theta decay. So for every dollar in theta decline, you have to make up for it in stock price increase. So that's at least a couple of thoughts regarding the worst that can happen. I haven't had very many terrible situations with this.
Are there variations of the wheel that are worth considering? For instance, adding a hedge?
I've done some collars. I have a variation of the wheel that I call my Wednesday at the money trade, and that has been fairly profitable. It's generated about 30%. Now, the setup for that trade is to look for stocks with high premiums. So to a degree, we're chasing premium. Then on Wednesday, buy the stock. So now I'm how much do I want to buy? Buy the 100 shares of the stock, sell the at the money call. So if I bought it at 100, I sell an at the money call at 100, and I pocket that premium. Could be $300 to $500 on 100 shares of X, right? And then the position closes normally on Friday. If it closes profitably, then stock gets called away, but I pocketed X amount of premium in a couple of days. And sometimes I'll make a little bit of money on the actual underlying itself. And if I lose money, I tend to exit and restart the process the following week because I'm running this as a P&L, and I'm just saying, hey, I'm going to have some losses. I'm going to have some, more wins than losses. And certainly in the setup to the stock, to the purchase, avoid earnings releases, stocks that are in the middle of earnings.
Paul, if you were to set the wheel strategy as you trade it on a risk profile scale from 1 being very low risk to 10 being very high risk, and you are free to define 1 and 10 for yourself, where would you put it?
Well, let me put it to you this way, is that let me define terminology in that a 1 would be buying a T-bill. Right, there's virtually no risk in that. 10, buying a lottery ticket with all risk and no control. Okay, so the wheel strategy, I'd say I'd put it at a 4 out of 5 and 10. It is not risk free. Nothing in life is risk free. I could walk down the stairs tomorrow and fall, but you can own the stock and that goes down. But compared to, you can still own it, I think, when the stock goes down, but compared to buying the stock outright and just holding it, it's safer because you're collecting income all along the way. And I can show you graph after graph of situations like this, but I would give it a 4 to 5. It's a fairly low risk strategy. I like it for the buy and holder. I say to people who buy and hold, you have more risk than me by a lot because you're buying and holding. And they're like, well, you're trading options. I'm like, no, you don't understand. I'm bringing in income every single day and reducing my cost basis. So you stay the same. And if there's a market downturn, you have to sell stock as a retiree to meet your monthly bills, your monthly expenses. I generate enough wheel income that I'll take out of that to fund life. So it's a 4 out of 5 on a 4 out of 10 or 5 out of 10 on my scale.
Tell us a bit more in detail about your results of trading this strategy over the years that you have traded it.
Well, I'd say that my results have been quite routinely on wheel, 12 to 15% on my investment in option in premium, and then another 3% dividends added to that. So 15 to 18% per annum is what I tend to bring in, remembering all the while that I've got this capped growth situation occurring because of the short call when I sell the covered call. I've spent a fair amount of portion of my life in performance management. So, what gets measured gets done. I measure income. I measure annual income on capital. So, while I'm in the trade, annual income on capital, always looking at that and ensuring that it stays, in the 12 to 15% range. And then when I exit every trade, I do a post-mortem and I track annual return on the overall trade. That then includes the underlying post-exit. And that gives me a really good sense of how am I doing. This is a real account that I traded. I traded the wheel for a couple of friends and families. So let me focus on two aspects of this chart. Okay, the top right corner, there's a graph that just goes up like this. It has a little flat period in it. But in about 24 months, I generated almost $80,000 in income on a $200,000 investment. So there's the 16% that I'm speaking of. In the bottom of the chart, this shows how much of this came from option premium versus dividends. So in this case, $65,000 in option premium during that period, and then in the $12,000 in dividends. Now, looks like there's 3 years here, but the clock started in late 2022, and then I took another snapshot exactly 2 years later in forming this graph. So you will get very consistent revenues. If I were just trading and not rolling, like I talk about, I roll beneath my purchase price. If the stock price goes down, then it would be less than that by it'd probably be 50,000 instead of 77 or 60, somewhere in that range. But note that the dividend portion is fairly light, right? And I want to put an exclamation point on why should you consider trading the wheel anyway? Well, in the US, with the Standard & Poor's, NASDAQ, and Dow, there are about 500 stocks in that market basket that will provide a dividend. And a good dividend is 3%. Translated, you need $1 million to make $30,000 a year in dividends. So many people don't have $1 million, right? So how can you increase your income and have a smaller account? And the answer is the wheel strategy.
It's time to sum up. What are the most important pros and cons of trading this strategy as you see it, and who is this strategy best suited for?
I'd say this, in a few words, the wheel strategy lets you get paid while you wait. So if I'm waiting to buy a stock, I get paid. And then I get paid again while I'm holding the stock. It's a very steady, it's a very repeatable process, and it puts you in great control over your assets. To me, I would say it's suited for busy people. It's suited for sci-fiers, set it and forget it people who are busy, but they want to bring in income and they don't have a lot of time. It's a great way to do it. You have to learn how to drive. You have to learn how to drive the car of the wheel, and there's a vernacular to it. But once you get it, it's really well worth doing. And then I would say two other points is to say that anyone who is a lifelong learner and you're looking for regular income well above dividends, the wheel is a tremendous place to go as a strategy. And finally, any person who has run what I'll call the miracle of compounding calculator and you understand the difference of how much an extra percentage point or 2 or 10 can mean to your portfolio over the long run, you'll be very wealthy if you start this early in your life. I wish I had started it in my 20s or 30s when I started investing. But nonetheless, it has been a tremendous income generator. So it's well suited for that. There are some cons, like we've talked about, with some of the downsides. If a stock hockey sticks up like Meta did, or if they go out of business like Bed Bath & Beyond. But those are, 1%ers, 5%ers. They don't happen that often in regular trading, I don't think.
What would be good resources to learn more about the wheel?
There are a couple of places that I go to. Ben Graham, The Intelligent Investor. This is widely promoted by Warren Buffett. I like the thinking in the book. And the main thing I would say is, as a takeaway, is look for stocks where revenue is increasing, the revenue per share, and look for stocks where their EPS is increasing. Because if those two numbers are increasing, if EPS is up on Coca-Cola 30 times what it was 20 years ago, now the stock price should reflect that, right? And then there are a couple Facebook groups. There's one called Options Wheel Strategy. There's another one called Dividend Stock Mastery, which I like. I've watched many YouTube videos on this. The challenge I find is that so many of the talking heads that are out there are that they are 11 layers deep into trading, and they talk with such technical terminology that for someone who's getting into it, who might be at level 1 or level 2, it's hard for them to follow. So you got to watch that. But I mean, there's so much good information out there. And then I do, and actually starting up in next year, I will do a series of Zoom workshops beginning in January 2026. These are free of charge, and they're just meant to be informational to help people. The reason I do this is because I had a mentor and a guy named Dale Perryman, and he really helped me get started with that. And without that, I would have been all over the place, just trying to figure out which way was up. So those are a couple of areas for ongoing learning. I go to the Options Industry Council. Has been a good place for me to get up on various option trading strategies, and that has been a starting point for me for much of my learning.
And Matt Cashman from the Options Industry Council have already done 3 interviews with us on 3 of the option Greeks. And also Dale Perryman, that you have mentioned a couple of times, have done 3 video interviews on this channel, so you can check them out. I
would add one other point to this that's non-option, but it's sort of a very macro level view of the market. Is there's a gentleman named Meb Faber, who is out of Manhattan Beach, California. And I met Meb a number of years ago, but he has a weekly podcast. And if you want to really get a high level sense of what's going on within the securities industry, the impact of the political overlay on top of the industry, and how it impacts general stock prices and many other very interesting topics, I listen to him all the time. One of the most valuable podcasts financially that I listen to.
Paul Gundersen, thank you very much for sharing your knowledge and experience of trading the wheel with us.
Jan, it is my pleasure. Tack.
Okay. Bare hyggelig.
Have a wonderful day, my friend. Take care. Thank you.